Hey guys, how is it going? Hope everything is well with you. I just want to talk a little bit about the real estate professional as it relates to taxes, not as it relates to buying and selling property or negotiating on behalf of a client if you're a real estate broker agent, right? This has to do with the IRS and how they view property owners, people that deal in that world, and some of the rules that pertain to be considered a real estate professional. And now this is really important because that's going to determine how much of a deduction you can get on your tax return when you own property. Okay. So, number one, there are two rules that you need to know. The first rule is you have to qualify as a real estate professional, right? And number two, you have to have material participation. So, I'm going to talk about those two rules. So, you qualify as a real estate professional if you work a regular job or work a 9 to 5 job, you own property, you could be considered a real estate professional. Okay. However, some businesses are more suited for that, meaning your side job or whatever you do mainly, and that's not real estate related. In this case, if it were real estate related, let's say you work in construction or something like that, you'll be considered a real estate professional, okay, without doing anything else. So according to the IRS, you qualify as a real estate professional for the purpose of passive loss rules if you meet both of the following. You perform more than half of your personal services for the year in real property trades or business. As I said before, if you work in construction, as an example, that'll be one. You perform more than 750 hours of services during the year in real property trades or business which you materially participate. Like I said before, that's a key one. Material participation is huge. So both prongs of the test require you to spend a great deal of time in the real estate trade or business. Okay. Now, for example, as I said before, if you run a construction company, your full-time job is, in the trade or business, the real estate trade or business, which means you probably already qualify as a real estate professional without doing anything extra. Okay. Okay. So, and the second rule is material participation. Once you can prove to the IRS that you're a real estate professional, you're finished and done. No, you're not, right? You have to show that you also materially participated in the properties. This is like a less difficult test than the real estate professional test. For example, you can show material participation in a property by showing any other following. You work more than 500 hours on the property, okay? You work more than 100 hours on the property and no one else worked less hours than you did on that property, okay? And you perform substantially all the work on the property. Now, the trick with material participation is that you have to meet the test for each property you own. Okay, this is different than the real estate professional test. Once you qualify as a real estate professional for the year, it doesn't matter how many properties you have. Okay, but for the material participation, it's by property, unless of course you group the properties together into one, and then you'll be able to qualify for those properties based on them being a single entity. Okay, so again, material participation and real estate professional, those are two rules you have to meet to really capitalize on the passive activity loss rules. Okay, otherwise you're capped at like $25,000. But if you meet those two rules, you'll be able to take more than $25,000. Okay. So here's some tips and tricks. Sorry. Tax breaks for those with smaller incomes. If your modified the gross income is 150K or less, you're limited to $25,000 as a passive loss. So $25,000 can offset your other income, and that's it. If you lost $50,000 on that property, meaning tax-wise, not really a literal loss, but tax-wise, because the bulk of the passive loss is going to be involving depreciation. Okay, and depreciation is a tax loss. It's not a real loss. Okay, so it's where you're recouping all the costs that you spent on buying the property. You don't get to deduct the entire thing in 1 year. I'm going to do a video on this too, so you'll learn more about that. Anyway, so we could talk more about qualifying for the $25,000 passive activity loss, you can, certainly reach out to me on that. Now, if you're a married couple, you can divide the material participation labor with your spouse and still make your rental properties an active business or investment. So instead of meeting, the $500 by yourself, you could split it with your wife or whatever, and then you could still qualify for that material participation rule. Okay. Now, you have to have the right proof. Okay. When you deal with IRS, like with anything with IRS, you have to have the right proof, good records that, the IRS, if they come at you, trying to audit you or something, you'll have records to show that you did materially participate and you're a real estate professional. Okay. And the material participation rule, sometimes it's hard to track that. Or if you do have it, if you don't track it right away or timely, on a consistent basis, it could be a problem. Okay. I've had one client that had an issue with this and really couldn't prove it, and they lost on the deduction. So you need someone like me to help you track that down. Okay. So as I said before, the IRS wants to investigate, then you have to have the right documents to show them, right? And you want to basically have this thing audit proof. Okay. You want it to be audit proof so that if they come at you, you can support your deductions. Here's some key takeaways. A good rental property is not just a source of income, it's a source of tax deductions that you can use to offset your income from other businesses or even the wages. Okay. When you add up your deductions for depreciation, property tax, and other expenses, you incur the property, you might have an overall tax loss if you collect rental income. That's the beauty about real estate, or one of the beauties. Many rental property owners really rack up a lot of passive losses over year. So you really want to tap into that and use it, to make it work for you. The biggest benefit from real estate with the property is the appreciation value. Okay. And it also provides you a tax shelter you can use against all other sources of income. Okay. That's a true tax shelter, not the stuff that is funny stuff that they have on the street sometimes, that that deemed by the IRS as being inappropriate. Okay. So having rental property is a true tax shelter. Now, the tax law classification of real estate professional and material participation, that's just going to get you to where you're able to deduct these items. So if you've learned something new, or it reinforced something that you already learned, please like, subscribe, and share this video. Before I go, attend my webinar March 1st. I'm hosting a free live webinar, and it's going to be from then until every first of the month until July 1st. It's called How You Protect Yourself from the IRS and Resolve Your Tax Debts. The link to the registration can be found right here in the description of this video, or simply search for me on Eventbrite. Okay, guys, nice talking to you. I'll talk to you another time. Have a great evening. Bye.